Welcome to this session in which we will discuss fraudulent conveyances. What's conveyance? Conveyance is passage, delivery. You're giving something to someone, transferring something. But that transfer is what type of transfer? It's a fraudulent transfer. So fraudulent conveyances refer to a situation where a debtor, who's a debtor? A debtor is someone that borrowed money from a creditor, from the bank. And what they do now is they're trying to transfer their assets illegally. Why? Because they don't want the creditors to get their hands on their assets. So where a debtor illegally transfers property to avoid paying creditors. This type of transaction is either void, means, or can be reversed. Void, it means it's not good, or the court can reverse it. Means you did this transfer, now the person that you transfer it to, give it back to the debtor so the creditor can claim it. So to determine whether a transfer is fraudulent, the court would look at several factors. In this session, we would look at these factors to give you an idea whether a conveyance is considered fraudulent. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. There are several scenarios that the court considered that the fraudulent is conveyance. 1. Transfer to an insider. If the property is transferred to someone close to the debtor, like a family member, brother, sister, or a business partner or a co-owner, it might be fraudulent. Why? Because you're giving it to someone you have a relationship with. Well, if you retain it, if the debtor still controls the property after transfer it could also indicate fraud. It means you're transferring it, taking it out of your name, but at the same time you're still using it. You're still in possession of it. You still can control it. Well, guess what? That's not really a true transfer. 3, it's a secret or undisclosed transfer. It means it's a hidden or not made public. This makes this type of transfer suspicious. So if you did not disclose it and it was discovered that you sold something or you transferred something, once you have that secret or undisclosed transfer, as far as the court is concerned, it becomes suspicious. Now, when does it become suspicious? It's because the point here is the debtor is trying to get rid of their assets fraudulently because they don't want the creditor to get their hands on them. That's why if it's secret, why did you not transfer it in public? Tell everyone about it. 4, you transfer of nearly all your assets. If the debtor transfer almost all their assets, it could be an attempt to avoid that because you don't want to have any assets. Therefore, creditors can't get their hands on your assets. Unreasonable value. If you transfer it or sold it for much less than it's worth, it might be fraudulent because you want to get rid of it, get the cash, and you can use the cash for anything else. You don't have the cash anymore. Or insolvency before or after the transfer. So what you did, if the debtor was or become insolvent around the time of the transfer, it might be fraudulent. So the court would look at all these indicators, signals, that those are fraudulent conveyances. Now, obviously, the debtor will have to defend themselves if they think it's otherwise, but this is what the court will be looking at. Let's take a look at an example. Let's think about John, a business person, owns a large sum of money to several creditors. John fears that he will not be able to pay them back. His business is going down, so he has assets. So what he would do to avoid this, to avoid giving them back any asset, he transfer his main asset, like his company and properties, to his sister at a very, very low price. At the same time, he continued to manage the business as if nothing changed. So what happened here, he's still in control, but he transferred his asset to his sister. So there are some indicators that John trying to do a fraudulent conveyance. When his creditors sue him for repayment, they discover these transferred. Now in court, these transfers are likely. Notice likely, because we don't know. We don't know what's his relationship with his sister. Maybe his sister is one of his creditors and he's trying to satisfy his sister. We don't know. But the point is, in the absence of any information, these conveyances are fraudulent, are likely to be considered fraudulent conveyances because John transferred major assets to a close relative for less than their value at the same time he retained control of the business, and did all of this while being in debt. So he's not like a rich person, a lot of net worth where he can do that. The court can reverse these transactions, ensuring that the creditors have a chance to claim what's owed to them. And this is where the court comes in, and they will try to either void these transfer or reverse them to go back and put them in the name of the debtor. Then the debtor will be forced, in quote, forced by the court to transfer them to the creditor to satisfy their debt. What should you do now? You want to go to Farhat Lectures, look at MCQs. If you're studying for your CPA exam, I have MCQs, AI CPA MCQs. Invest in yourself. Good luck, study hard, and of course, stay safe.